Hey there, Iggy the Investing Iguana here. Today, I've got some exciting news for all you savvy investors out there. In this video, we'll be diving into the world of S-REITs and uncovering a fantastic opportunity that you won't want to miss. Picture this, S-REITs are currently trading at a whopping 20% discount compared to their historical average. That's right, folks, it's like a massive sale on some of the best real estate in Singapore. I'll be breaking down what this means for you and how you can potentially capitalize on this incredible chance to grow your wealth. So, grab a snack, get comfortable, and let's explore the exciting world of S-REITs together. You might have heard the term REIT and wondered what it means. REIT, or Real Estate Investment Trust, is a type of company that deals with real estate. These companies own and manage properties that generate income. This could be anything from apartment complexes and office buildings to shopping centers and hotels. When you invest in a REIT, you're essentially buying a piece of these properties. You become a part owner, so to speak. This means you get a share of the income these properties generate, usually in the form of rental income. It's a way for regular investors to get involved in real estate without having to buy entire properties themselves. It's a pretty neat concept, isn't it? However, like all investments, REITs come with their own set of challenges. Recently, they haven't been performing as well as investors would like. The main reason for this is the rise in interest rates. You see, when interest rates increase, it becomes more expensive for REITs to borrow money. This can put a squeeze on their profits, which in turn can lead to a drop in their share prices and valuations. It's similar to when the price of your favorite snack goes up. It's disappointing, but it doesn't mean you stop eating. You just have to adjust your budget accordingly. In the same way, a rise in interest rates doesn't mean you should automatically rule out investing in REITs. It just means you need to be aware of the current economic climate and make informed decisions. After all, investing is all about balancing risk and reward. And who knows? With the right strategy, you might find that REITs are a tasty addition to your investment portfolio. The S-REIT sector, which refers to Singapore Real Estate Investment Trusts, is currently facing some challenges. However, it's important to note that these challenges have led to an interesting situation for potential investors. As of now, the S-REIT sector is trading at a significant discount, nearly 20% lower compared to its historical average. This means that the shares of these REITs are available at a price lower than their usual cost. To understand this better, let's look at the iEdge S-REIT index. This index tracks the performance of REITs listed in Singapore, providing a snapshot of how the sector is doing overall. Currently, this index is trading at a price-to-book ratio of 0.87 times. The price-to-book ratio is a financial valuation metric used to compare a company's current market price to its book value, and a lower ratio could indicate that the company is undervalued. Interestingly, this ratio is lower than the index's 5-year average of 1.04 times. This suggests that, on average, the S-REITs are currently undervalued compared to their performance over the past 5 years. In simpler terms, it's like there's a sale going on for S-REITs right now. For potential investors, this could be a golden opportunity to buy into the real estate market of Singapore through these REITs, especially if they believe in the long-term potential of these assets. Among the various REITs available in the market, some are currently trading at particularly large discounts. These include Mapletree Panasia Commercial Trust, Keppel DC REIT, Frasers Logistics and AMP, Commercial Trust, Keppel REIT, and Mapletree Industrial Trust. Mapletree Panasia Commercial Trust is a REIT that focuses on commercial properties located across Asia. Keppel DC REIT is unique in that it specializes in data center properties, a growing sector given the increasing demand for data storage and processing capabilities. Frasers Logistics and AMP, Commercial Trust invests in logistics and commercial properties, while Keppel REIT has a portfolio of commercial properties. Lastly, Mapletree Industrial Trust invests in a range of industrial properties. These REITs are currently trading at prices that are significantly lower than their own 5-year averages. This means that compared to their historical performance, these REITs are currently undervalued. This could be due to a variety of factors, including market conditions, interest rates, and specific challenges related to the properties they own. However, it's important to remember that just because a REIT is trading at a discount doesn't necessarily mean it's a good investment. It's crucial to look at the fundamentals of the REIT, including the quality of its properties, its management team, and its financial health. Moreover, it's also worth considering the potential for future growth. For instance, a REIT like Keppel REIT, which invests in data centers, could have significant growth potential given the increasing reliance on digital technologies. Indeed, Keppel REIT has made a significant move recently that's worth discussing. They have decided to acquire a 50% stake in a freehold Grade A office building located in Sydney, Australia. The cost of this acquisition is a substantial 323 million Singapore dollars. This property is situated in the heart of Sydney's Central Business District, CBD, core precinct, a prime location known for its bustling business activities. The building boasts a high occupancy rate of 93%, indicating that a large portion of its space is currently leased out. Furthermore, it has a weighted average lease expiry of 6.8 years. This essentially means that the current tenants have long-term leases and are expected to stay for a while, providing a steady stream of rental income for the foreseeable future. The management of Keppel REIT has high expectations for this new addition to their portfolio. They anticipate that this property will generate a first-year yield exceeding 6%. This is a significant return, especially considering the current economic climate. Moreover, they expect this acquisition to boost their distribution per unit by 1.4%, which is a considerable increase. This acquisition is a strategic move that significantly enhances Keppel REIT's portfolio. Following this acquisition, the total value of properties under Keppel REIT's management will be around 9.6 billion Singapore dollars. These properties are not just limited to Singapore, but are spread across several countries including Australia, South Korea, and Japan. This geographical diversification could potentially provide a buffer against market volatility in any single country and offer a balanced mix of properties from different real estate markets. If you're intrigued by the potential of Singapore real estate investment trusts, S-REITs, but prefer not to invest in individual REITs, there's another option you might want to consider: REIT exchange-traded funds, ETFs. ETFs are investment funds traded on stock exchanges, much like individual stocks. They hold assets such as stocks, commodities, or bonds and generally aim to track the performance of specific indexes. REIT ETFs, in particular, are composed of multiple REITs, allowing investors to gain exposure to a diversified portfolio of income-generating real estate assets with a single investment. In Singapore, there are currently two pure-play S-REIT ETFs listed: the CSOP iEdge S-REIT ETF and the Lion-Phillip S-REIT ETF. The CSOP iEdge S-REIT ETF is an exchange-traded fund that aims to replicate as closely as possible, before expenses, the performance of the iEdge S-REIT Leaders Index. This index is designed to reflect the performance of a portfolio of REITs listed in Singapore. On the other hand, the Lion-Phillip S-REIT ETF is managed jointly by Lion Global Investors Limited and Phillip Capital Management. It aims to replicate the performance of the Morningstar Singapore REIT Yield Focus Index, which is designed to screen for high-yielding REITs with superior quality and financial health. Investing in these ETFs can offer several benefits. For one, they provide diversification, as you're investing in a basket of REITs rather than a single one. This can help spread the risk. Secondly, they offer liquidity, as ETFs can be bought and sold during market hours just like individual stocks. Lastly, they provide access to a range of REITs that might be difficult for individual investors to invest in directly. So there you have it, folks. While REITs have faced some challenges lately, there are still opportunities out there. Whether you choose to invest in individual REITs or opt for a REIT ETF, always remember to do your own research and consider your personal financial goals. Alright, folks, that's a wrap for today's video. We've covered a lot of ground, from understanding the current S-REIT landscape to identifying some of the most attractive opportunities in the market. Remember, investing in S-REITs while they're trading at a 20% discount could be a game-changer for your portfolio. But, as always, be sure to do your own research and consider your personal financial goals before making any investment decisions. If you found this video helpful, don't forget to smash that like button and subscribe to the Investing Iguana channel for more insights and tips on navigating the wild world of finance. And if you have any questions or topics you'd like me to cover in future videos, leave them in the comments below. Until next time, this is Iggy the Investing Iguana, reminding you to stay curious, stay informed, and keep on investing.